Hi, I'm Stuart Fitzpatrick from Excel Financial Advisors. Welcome to the second episode of Building Better Futures. The things I'd like to talk to you about today are the changes to superannuation coming into effect from the 1st of July and the tightening conditions in the housing loan market. I'll touch briefly on both topics, and then if anyone would like to get in touch with me to discuss in further detail, please feel free to give me a call. As always, anything we discuss in this format is of a general information and education nature only, and it's not to be taken as advice. I haven't taken into account your personal needs and circumstances, and you should not act on this information without considering how it actually impacts on your situation and seeking professional advice when necessary. So the first thing I'd like to talk about today are the changes to superannuation. And in particular, two of the major changes. The first one relates to the amount of contributions that you can put into the superannuation system, and the second one relates to some changes impacting on pensions. So firstly, contributions. Currently there are two types of contribution caps or limits that put a ceiling on how much you can put into superannuation each year. They are the concessional contributions cap, which applies to contributions where a tax deduction is claimed. So either by a self-employed person or by an employer for their employees, whether they be employer contributions or salary sacrifice contributions. The second cap is called the non-concessional cap, and that is where no tax deductions are claimed. So the actual caps that apply at the moment are $30,000 for anyone aged 50 or under is the current concessional contributions cap, although there's a slightly higher cap of $35,000 for anyone aged 50 or over. From the 1st of July, the concessional contributions cap will be reduced to $25,000 per year for everyone. And the second contributions cap that we need to take into account is what they call the non-concessional contributions cap. Now, at the moment, that is based on a multiple of 6 times the concessional cap, so $180,000 per year. But from the 1st of July, will be reduced to a multiple of 4 times the lower cap of $25,000, so it will be $100,000 per year. Now, at the moment, you can actually bring forward 2 years of caps to make a combined cap or non-concessional cap of up to $540,000 before the 30th of June, spanning a 3-year period. And from the 1st of July, that amount will be reduced to $300,000. And there's some transitional measures that apply for people that have actually gone over the $180,000 this year, but not used the full $540,000. The final thing I'd like to highlight in respect of contributions is from the 1st of July, once your actual superannuation balance across all funds exceeds $1.6 million, you won't be able to make any non-concessional contributions. And there's a limited ability to make them as your balance approaches the $1.6 million. So that's sort of the main areas of contributions I want to talk about. The other area is to do with pensions, and basically 2 major changes there. The first change is from the 1st of July, there will be what they call a pension balance transfer cap of $1.6 million per person. What that effectively means is the government has said from the 1st of July, $1.6 million is the total balance you can have as at that date. That is in pension mode and will receive full exemption from tax. Now, that is a line in the sand date, 1st of July. If you start a pension after that date, the $1.6 million applies. And it is actually indexed over It could take several years before the actual indexation goes through, but it's indexed in $100,000 multiples at CPI. So that's basically a $1.6 million cap on the amount you can have in a pension that the earnings are exempt from tax from the 1st of July. The second pension change I want to talk about is in respect of transition to retirement pensions. And at the moment, any earnings from investments supporting those pensions are actually exempt from tax, but that exemption will be removed from the 1st of July. So therefore, the normal 15% tax rate that applies to non-pension accounts in superannuation will also apply to transition to retirement pensions. So anyway, that's an overview of the major changes to superannuation from the 1st of July. There are a few other little changes or minor changes, but they're the major ones I'd like to talk about today.
Stu, I thought the government wanted us to save for our retirement by putting money into super. Why are they making these changes which reduce the ability and the incentive to save?
Well, Melissa, it basically comes down to affordability. The amount that is accruing in the superannuation system is getting larger each year, as are the tax concessions that have been provided for pensions. And with the competing pressures on the budget, including funding a growing aged care and also aged pension expenditures, some adjustments are required. Now, both sides of politics agreed the changes were required, just a different approach. So that's basically it. It's just a simple question of affordability.
But doesn't this undermine confidence in the superannuation system?
Yes, Melissa, the quite regular and what appears to be constant changes to superannuation do undermine confidence in the system. People, particularly those nearing retirement or having just gone into retirement, were basing their plans around arrangements that existed at the time or leading up to retirement, and unfortunately some of those arrangements are now taken away. So no one likes losing concessions, but at the end of the day, look, superannuation is still a concessionally taxed savings environment. I wouldn't give up on it. Legislative risk is always going to be there. Changes will be made, but maybe it's now a dual approach of saving inside and outside super.
Why has the government set the pension balance transfer cap at $1.6 million? Will this be enough to fund a reasonable lifestyle in retirement?
Oh, great question, Melissa. Look, no doubt there was extensive modelling done, and at the end of the day, a number had to be chosen. Now, whether this proves to be enough for everyone, only time will tell. But if we could assume, say, a 5% net earnings rate, 1.6 million is sufficient to generate a pension of an index pension of $70,000 a year for 30 years. Now, a lot of people would actually think that that's sufficient in a nil taxed environment, and of course those that have balances above the 1.6 still get to enjoy a 15% tax rate. So in all, it seems to be a reasonable measure.
How many people will the 1.6 million pension balance transfer cap affect?
Well, Melissa, initially the government is predicting it will only be a relatively small number of people, but over time, when the full spin-off effects are taken into account, you'll see that number growing. Now, at least one of the good things is the government has decided to actually index that cap so that inflation can be taken into account. So every few years, in $100,000 multiples, the cap will be increased to take into account inflation. So at least the younger generations won't be losing out because of the inflationary effect on the cap.
Stu, you mentioned there were spin-off effects from the 1.6 million pension balance transfer cap. Could you share an example?
Well, I can think of a couple, Melissa. The first one would be the 1.6 million cap is an individual cap per person. Now, at the moment, if a member of a couple dies, either their pension can continue as a reversionary pension to their spouse, or a death benefit pension can be commenced, and there's no cap on the amount of those. Now, any reversionary or death benefit pension now has to be considered under the surviving spouses or the reversionary spouses cap. Another effect could be the looking at the estate planning implications of how we leave pensions. So this is an area where professional advice is going to be necessary.
Stu, is there anything our clients should do now?
Well, yes, actually, Melissa, there's a few actions that can be taken before 30th of June. The first would be to look at getting money into the superannuation system using non-concessional contributions. Obviously, anyone that is impacted by the 1.6 million transfer cap, we need to look at some tax planning on capital gains, for instance, and people that have transitioned to retirement pensions, and in particular in conjunction with the salary sacrifice strategy, may want to reconsider those with effect from the 1st of July. So they're a few things I can think of that are going to be keeping us pretty busy over the next couple of months.
Okay, so the other thing I want to talk to you about today is the tightening of conditions in the home loan lending markets. Now, you would have seen in the press or heard on the news that property prices have been growing fairly strongly in the last 12 months across most of the eastern city CBDs, in particular Sydney though, and that the regulators are looking to try and slow down the growth in property prices. Now, the actions that they're taking are not actually limited only to, or the effect of the actions they're taking will not be limited only to those areas where there's been strong growth, but actually will have a flow-on effect to all investment lending and property prices in general. Now, I've been involved in the finance industry for 37 years, and for as long as I can remember, the lenders and mortgage insurers have had their own internal policies limiting exposure to particular areas where they find they might be overexposed, or to particular developers or developments. The actions being taken by the regulators are over and above the own internal controls of the lenders and mortgage insurers, and they are more macro in nature, looking to limit the growth in property prices by limiting the growth in investment lending by the banks to no more than 10% per annum, and of more recent times to actually limit the amount of interest-only lending that's being done. So again, these are big picture or macro solutions to issues that are basically more concentrated or of a local nature. Now, the responses being taken by the lenders actually will vary depending on their own circumstances, but it could be restrictions on the areas they lend in, the loan to valuation ratios, increasing interest rates for investors, or restricting the type of lender that they lend to, say limits on new customers or SMSFs or foreign investors. Now, of course, the actions in slowing down investment lending will are not just concentrated on new developments, but they actually will have a flow-on effect for established housing as well. And one particular area that could be of concern for some of our clients and investors in general is in respect of off-the-plan purchases where they've made decisions a year or 2 years ago based on conditions at the time, and now the regulators are imposing conditions on the bank, which makes it harder to actually achieve that lending. May make it a little bit hard to actually complete settlements without some action being taken to try and offset the actions by the regulators. So if anyone's exchanged contracts off the plan a year or 2 years ago and are worried about how they're going to achieve settlement, please give me a call. We'll find a way to work through it. Now, the other thing in respect of lending market conditions I want to talk about is more of a natural tightening of interest rates. Now, the Australian banks, the lenders, the non-bank lenders, don't source all their money here in Australia. And estimates are generally around about the 40% mark of funding is sourced from overseas. Now, while the Reserve Bank has had interest rates on hold here in Australia for a while, and I expect will continue to do so, the actual cost of funding coming from the US has been increasing because the interest rates generally in the US are being increased by the Federal Reserve. So the cost of funding here to Australian banks is increasing. They are starting to pass that on to lenders. It's not a uniform increase that they're passing on. They're probably passing more interest rate increase on to investment borrowers because that's what APRA is requiring them to do to slow down that market. But there will be an increase in rates, I think, for owner-occupiers and to a greater extent investors. So my outlook for rates, Reserve Bank on hold, but the actual interest rates here in Australia for lending market will start to increase. Now may be the lowest it will be for some time. So if anyone's looking at locking in interest rates, could be a good time to do that now. Another flow-on effect I think you should be aware of is when there is a narrowing of the gap in interest rates between rates in the US and rates in Australia. It generally leads to a devaluation of the Australian dollar against the US dollar. So anyone that's looking to travel to the US may think about buying some US currency now. And anyone that's invested in US stock market probably would want to be in an unhedged currency position at the moment.
Stu, what do the tightening lending conditions mean for our clients?
Well, Heather, initially it's going to mean you're going to need a slightly bigger deposit or possibly scale back on the value of the property that you're looking for. So a little bit harder to get into investment property at the moment. Rising interest rates mean that initially it's going to probably cost you a little bit more out of your own pocket to hold an investment property each week. But quite often rising interest rates also flow through to rising rents. So when the balance of supply and demand adjust, you may see rising rents offset this. And at the moment, one of my biggest concerns is for those people who've exchanged contracts off the plan. If anyone's in that situation and think they may have trouble settling, please call me and we'll see what we can do for you.
Stu, do the changed lending market conditions present any opportunities for our clients?
Well, Heather, there's often opportunities when you know where to look, and at the moment that's no exception. With the changed lending conditions, we're actually finding that some developers are offering significant discounts for off-the-plan sales. So whether it be a discounted purchase price or incentives. Now, just because something has been reduced in price or there's incentives thrown in doesn't necessarily make it a good buy. So it's a matter of checking your facts. You need the right property, right market, right price and right time to make money in real estate investment. So anyone that's interested finding out a bit more, give us a call.
Stu, is there anything else happening in the property markets that our investors should be aware of?
Well, yes, Heather, at the moment, say particularly in Victoria, for investment properties, the Victorian government is removing or substantially reducing stamp duty concessions from the 1st of July. Now, at the moment, Victoria is the only state where you pay stamp duty based on the stage of completion at the time you enter into a contract, not on the end purchase price. So, for an apartment development, that could be something like a $20,000 to $30,000 saving, depending on the price and the land value. So that's one area that people might want to consider if they're looking for an investment property. Please give me a call.
And Stu, have you got any other tips that you'd like to share with our clients today?
In the first episode of Building Better Futures, I highlighted that improving your financial knowledge can lead to improved financial position and better capacity to build a better future. Now, the government actually agrees with this, and they've started launching initiatives to try and help people improve their financial literacy. One of these is the ASIC Money Smart website, which has a range of videos, tips, calculators and case studies that people may benefit from. Now, it's not a substitute for professional financial advice, and it's not meant to be, but it's a good starting point and maybe all you need for some of the simple matters.
And what about any traps to avoid?
Well, Heather, one trap to avoid would be just be careful with offers of interest-free finance. Now, even in a low interest rate environment as we have globally, a lender has to make a return on their money, and if it's an interest-free loan, you have to think about where that return is coming from. So just check carefully the price you're paying for the goods, shop around, make sure it's not being inflated to offset the interest costs. And one thing would be to offer a cash price and see if you can do a better deal. And of course, understand the terms of any of the interest-free finance and the implications if you are late with payments. So that's my tip for today.
I've always had a passion for reading, which is a good thing in my line of work. I enjoy fiction novels, biographies, history, and over the past few years I've set a goal of reading at least 6 personal improvement or business improvement books a year. One of the best I've come across and highly recommend is Simon Sinek's Start With Why. It's all about understanding what gives us purpose and what drives us. If you pick up and understand the concepts Simon addresses, it'll significantly change the way you go about doing your work, either as a business owner or an employee. And if you don't have the time at this stage or not into reading books, I'd suggest you have a look at Simon's famous TED Talk, which is called How Great Leaders Inspire Action. It runs for about 18 minutes and it's definitely time well spent. As we discussed earlier, there's a fair bit going on in the housing loan market at the moment, with lending conditions tightening and the first indications of rising interest rate market. Now could be a good time to review your current home or investment loans to see if there are better deals available before conditions tighten further. We'd like to help with that. We normally charge a fee of $550 for this service, But to celebrate the launch of our Building Better Futures program, we'll waive this fee for anyone who takes us up on the offer before the end of May. So give us a call, take the next step. Thanks again for watching the second episode of our new program, Building Better Futures. We're excited to be able to communicate with our clients and potential clients in this new format. We'll still be doing our monthly newsletter, and sometimes the issues we discuss may cross over a bit, sometimes they won't, but we'll cover them slightly differently. We'd love to hear your feedback on what we did well and what we could do a bit better next time. I'd really welcome your ideas on topics for discussion so we can make the Building Better Futures program of great benefit to our clients. And of course, if you know someone who may be interested in any of the issues we've discussed, please send them a link to the video or refer them to our website or Facebook page. Until next time, it's Stuart Fitzpatrick and the team at Excel Financial Advisors signing off.